I'm Frazer Bourchier, the President and Chief Executive Officer of Mandalay Resources, multi-asset gold producing company, mine in Australia, mine in Sweden. I've been engaged in this industry for 35 years and extremely excited to share our story of growth.
Frazer, lovely to meet you.
Yeah, likewise.
And it's rather beautiful setting, it must be said as well. So
there are worse settings, yes.
It doesn't hurt. Right, we've never met or spoken before.
No,
so why don't we start with a little bit of background on you? What have you done before? Where have you had success?
Well, look, I mean, going back 35 years, I've spent half my career with a large gold mining company. It was the second largest in the world at that time, called Placer Dome, before it became part of Barrick Gold Corp. And then the second half of my career so far, I've worked with operations, Nevson Resources, silver, wheat and precious metal now, Detour Gold. So quite a range. I've worked internationally. I've worked nationally. I've worked out at the operations, lived in different countries, worked at corporate office, been an executive. Really my background is a mining engineer, chief operating officer, was operations, and then progressed to the executive leadership ranks the last 5 to 7 years.
Okay, so big boy stuff.
Yeah, I guess
right?
So, yes.
Where you have learned a thing or two, how much, and you've obviously been doing this for a while with Mandalay, how much were you able to kind of bring through into the kind of junior space? Because it's a very different beast.
It is. And it's interesting you say that. I mean, the transition to big company mindset to smaller company mindsets, it's an important one. I mean, there are fantastic things I learned in the first half of my career that you just can't pick up because of the resources available at big companies. But transitioning to the smaller size of the market, you learn to be more nimble, quicker in terms of how you operate. I mean, I've been at Mandalay for 16 months. I'm a relatively recent hire, but I can bring, that skill of how you operate small operations without having to spend a lot of money, manage your costs, be pretty involved, while also providing leadership and not micromanaging.
Okay. I mean, at this level, it is about the efficiency of capital allocation, isn't it?
100%. Oh, it always is, I would say, but certainly at this level, because capital is that much more strict.
Is that true? Hang on, are we going to have an argument? So you're saying the big companies are efficient. I think they're famously inefficient at exploration.
Well, they're true, yes. In fact, maybe that's why they let the other players burn their money up in exploration and snap them up when it's the right time.
Yeah.
I mean, exploration obviously has a certain success rate too, which is riskier and extremely rewarding when it works, not so much when it doesn't.
Right.
Correct, yeah.
Okay. Well, I'm always intrigued to get to know what's going on in the mind of the individual in front of me. Business plans, my favorite topic, because I think it sets up the company, assuming the team's good, which we'll talk about, and assuming the corporate structure is good, and we'll talk about that. But the plan, what's the plan? What were you brought in to try and solve or do?
Yeah, great question. I was not brought in to steady state run the company operation. Credit to the team before. They're two small but cash flowing operations. I was brought in with an operating skill set, certainly, but to grow the company. And the reality is, Matthew, in this market, scale and size matter. Delivering on plan matter. Generating cash. I'm, by the way, we'll get into that later. I'm not a big fan of debt. I don't like debt, and that's absolutely required. So I developed a strategy 2-3 months in after I visited each operation 3 times. Not that it took me that long to understand them. I just like to get out there. Australia, Sweden. Developed a strategy which was clearly continue focus on the operations and generating cash. Organic exploration. We've 10 to 15 years always replaced resources at pretty cheap cost, 1% to 2% of the spot gold price. But look at a growth strategy in terms of inorganic growth. Because scale and size are important just for capital markets, index listing, further diversity, trading liquidity for us. We have a fairly lean trading volume with our major shareholders having 75%. So that's what I've been involved in, and we've had some, and it's with other similar PNAV type companies that are kind of suffering from the same fate. They ideally produce in jurisdictions we're happy with, gold mainly, that's our focus, but need that size and scale as well. You work out the social issues. We're not entrenched here. Whatever makes sense for the shareholders, we'll move forward.
Okay. And I guess during this conversation, what I want to work out with the end game, right? The end game usually for me is some kind of monetization event, and it can take short while or a long while. It doesn't really matter. let's start with the assets first, and we'll kind of talk about inorganic growth. So organic growth, what state were they in? How much more efficiently can they be run? And is that a good use of your time?
Yes. So I'll split it quickly into Australia.
Yeah.
Is a relatively, or I'd say pretty high grade. It's one of the highest grade mines in the world. It's not large.
Mm-hmm.
Average grade is 10 to 15 grams a ton.
Mm-hmm.
Gold and antimony. Antimony is another whole
Very
interesting
popular
story.
at the moment,
Yeah.
We
are the biggest producer of antimony in the Western world. So apart from maybe Turkey and Bolivia, I mean, the rest, 85% is all in Tajikistan, Russia, and China. So that's a separate niche, not why we're in here. It's a great added benefit. But getting back to Australia on an equivalent basis, we have about 100% margin on a relatively small 400 ton a day plant. We can generate $60 to $70 million a year in operating cash flow. The focus area there, I mean, that mine's been operating since 1862. It's a long history. Right. Took 60 years off after World War II.
Right. Okay.
But, I mean, Bendigo Ballarat is what built the city of Melbourne. It's prolific, 55 million ounces in that belt. We will continue to generate 50,000 ounces a year equivalent on great margins, like I said, 100%. And it's always about replacing those reserves. They vary between 2 to 5 years, but they varied between 2 to 5 years.
A long time, that.
For the 15 years Mandalay's owned it, correct. And we replace that at $45 a resource ounce. So that's what we focus on there. Just keep it going, try to expand further, but let's just keep generating cash. And I'll tell you in a minute where we want to allocate that, the purpose of that. In one sense, it's completely different in Sweden. In Sweden, the land package is 10 times the size. The throughput in the mill is 10 times, 4,000 tons a day. We recently expanded that. The grades are probably 1/10. Mm-hmm. In fact, I would argue it's probably one of the most efficient underground operations. They're both underground. Average feed 1.6 grams a ton at 4,000 ton a day, and we make money there. Now, there's a lot of reasons for that. And it's $1,700-$1,800 an ounce all in, but that's still a 40% margin. It's never going to be a $1,400-$1,500 an ounce operation, but it can generate cash, efficient workforce, low, cheap, green power, 2.5 cents a kilowatt hour. It's not a camp environment, so you don't have those costs. Mm-hmm. And they're very experienced. Right next door to Boliden, just like Costerfield's pretty well next door to Fosterville. So we're in the shadows of giants. We have good operating history, and that generates cash. But that's two legs of the stool.
What's the number there?
At Björkdal?
Yeah.
Well, first of all, the ounces are about 45,000 ounces a year. At that margin, we can generate operating cash flow 30 to 40, free cash flow 20. Like we self-fund everything, all our exploration as well.
So combined, that's how much was the combined operating cash?
Yeah, combined. So consolidated, I mean, we're talking 95,000, 100 to 90,000, 90 to 100,000 ounces a year in cash. It can be anywhere from 50 to 70 million. I mean, that's approaching half our market cap.
You're talking about net?
Free cash flow.
Free cash flow. Nice. Okay.
Yeah. Which is close to half our market cap.
Well, that's the bit that frees you up for the next part of this conversation, which is, how do you deliver growth?
Exactly.
Okay. So you got some cash, and that's at the steady state there. You're not going to waste too much time trying to maximize the efficiency of each of those projects. They seem to be doing just fine. It seems a better use and allocation of your time to be focused on the new growth strategies. So what is it?
Well, the ultimate strategy, of course, is shareholder appreciation.
For sure.
So how does that come about? I mean, we believe the way to achieve that is through size and scale in terms of, ultimately, if we had a ton of cash and we saw a long line of sight, 10 years out, I would argue, let's start to dividend that back. We are not at that position yet. We need a bit more size and scale.
Yeah.
And we do have an NCIB, so we do some share buyback for return to shareholders. Mm-hmm. But to me, it's about becoming a mid-tier gold producer, get us from 100 to 300,000 ounces in the not too distant future. Ultimately, it's about cash, not ounces. And then you put that together, you get access to capital markets, index listing, more trading liquidity. We are seen at times as a semi-private company. I get it. We have 4 great shareholders. They have 75% of the stock. So there's not a lot of liquidity there. Yeah. So they understand the need to grow, diversify the registry, diversify the assets, and generate more cash.
And that to you means raising capital and therefore issuing more?
Well, I'm not even sure we have to raise capital.
But you just, sorry, I'm going to put it another way. Do you feel you need to reduce that 75% number to something which may allow liquidity events to happen?
100%.
Right. Okay.
100%.
How do you do that?
Well, let's take an example. Yeah. If our company were to combine with another company with a share register that may be more diversified as in our existing 4 shareholders, let's say they do not participate.
Would you encourage them not to?
We've had those discussions without saying much, and they understand. I mean, if you have 20% of a $200 million company or 10% of a 400 before a re-rate, you may have been diluted in ownership but not in value.
Yeah, you're standing still. That's fine.
Yeah. So I think they're great shareholders. They're very supportive.
Yeah, but they recognize the problem it does.
100%.
Right.
And in fact, the largest shareholder is our non-independent chair of the company. And the other shareholders have followed him, and I have a good relationship with Brad Mills, and the board has bought in and understand the strategy. The board is not stopping me in terms of what I have to do, so I'm not. It's a matter of executing. I tend to let you know up front, not overly analytical, but I'm prudent and diligent, somewhat risk averse, so I want to be careful. The next deal and subsequent ones need to be the right ones. We're not going hostile. It's friendly. I know that might spook some people. What are they going to do? Or maybe I'll wait to see. We're not going to do something dilutive. Relative, similar valuations, sort of the social issues, site visits. Let's combine and if gold is 1,800 or gold is 3,000, it does not change the relative story on a company. Buying assets, that's a bit different. That can be expensive in this environment. But
prices do tend to go up as gold price goes up, and there's a lot more competition, I suspect.
Exactly, it's a seller's market, so I want to be careful.
It's a producer's market too.
Yeah, true.
They've got a lot of cash,
which is great for us, yes.
Right?
Yeah.
Okay, so that gives us a sense of what the mechanism is. What's the kind of process that you'd go through, and what's the profile of a potential friendly merger?
Well, it's based on 2 things. Ultimately, one is relationships and getting out there and talking before advisors or banks get involved. Great, they certainly have a role. I'm much more of a CEO to CEO and eventually board to board talk. And knock off the most important things first. I mean, social issues, for example. I see some companies that my perception may be a bit entrenched and kind of like, no, we're doing well now. Gold price is up. It's like, okay, we're not going to go hostile here. But if there's a mutual agreement on vision and growth strategy, and then look, I'm an operator by experience, so it doesn't take long to just jump on a plane and do respective site visits. Make sure you're looking. You don't want to do all this work and go, oh, that's what it looks like. Have a quick visit, relatively cheap. Work out the social issues. How do you see the boards coming together? How do you see executive? And if there's alignment there, then you go in and share that with your board and the shareholders.
And because it increases the likelihood of success, because most of these things end in failures.
And willingness to you want somebody who's willing and everyone's aligned. So.
Right. But coming back to the profile thing, okay, jurisdiction, we're in Australia, we're in Sweden. Australia, renowned. Fraser Institute voted number 1, whatever. I love that. I love that.
That's not my institute.
I know. It just makes me laugh. Sweden, I guess, less well known, but a good mining country for sure. Lots of the big boys are in there. So no problems there. So that tells you, informs you. You got to be quite selective with which jurisdiction you enter into a conversation with a company.
So yes and no. I would say there's 3 things we look at.
Okay.
Or 4 actually. One is certainly jurisdiction, I can talk to briefly. The other is quantity. Like I said, it's mainly gold. We would consider some copper, but it's mainly gold. And then it's stage of, do I prefer producers? We wouldn't rule out a build or developer, but that's a different, like maybe a step 2 or 3 transaction for us, but to lock into a build right away, unless it's very manageable and the build team and permitted, fine, but we're not an early stage exploration come out.
Right.
To be clear though, I always believe that if 2 parties are coming together, there's a complementing of factors. So sometimes maybe they generate more cash, but they're in a slightly, tier 2 jurisdiction versus tier 1.
Right.
Or maybe, you complement, each of us always have hair on ourselves and each of us have gray spots. So if you can complement that together, and it's still manageable risk, then that certainly is.
Just clear something up for me, because you're talking about buying producers, right? So you're going to buy a kind of...
Or let's say combining. That's sort of one buying the other, but let's say it's an housing combination.
Okay, but it's kind of priced at the
Yes,
market, right?
correct.
It's a producer, right? So do you need to believe that there's a discovery, exploration, growth component to that, here that target is? Or is it just a case of we're going to roll up of a bunch of producers or perhaps of a certain size and that's us?
Oh, no. You want to have a sense there's growth there. I mean,
Right.
I mean, the more growth, without saying much, a couple we're looking at, it's not just about the ounces and ultimately the cash. It's what does the growth potential look like?
Okay.
That's very important. Yes. I mean, it's not just about, slapping together a bunch. Well, while scale and size matter, there needs to be a growth profile. And, that's the nature of our business. There's always that treadmill of replacing, but if there's a history of it, and that's the other great thing about producers as opposed to projects, the great thing about producers, you do the due diligence, but you're always a little bit more relaxed when there's a 10-year operating history there.
Yeah.
And versus one that's a project's all promises, but what's ever really come out of the ground? What's that resource model really look like? What's it going to? So that's why I like producers, but there also has to be a growth profile.
Yeah,
that we
okay,
both put in.
good. I just want to clear that up in my head. A lot of it's a buyer's market in the sense that they've got a lot of cash, and if you can find something at the right price, that's great. But there's a lot of competition, so there's no guaranteed success anytime soon without maybe overpaying or maybe going to a jurisdiction which.
No, that's a great question. I mean, so that's why there's a couple things that have to line up. And that's why these things can take a bit of time.
Yeah.
But we don't want to be sitting here 1 or 2 years from now on this certain line.
Well, there's a part two to that question, which is, if we're both accepting that may be true, in terms of time is not necessarily something you can control because there's a lot of competition and you don't want to overpay. You do want to be efficient. The second part is, what do you do in the meantime in terms of that growth brief that you've given? How does the growth happen?
Okay, I'll answer the first question first, then I'll get to our organic exploration on the second part. Look, on the first, without saying much, it's a pretty small universe out there. If I looked at all the publicly listed companies and all the main exchanges, it's probably 160 to 200. You suddenly put in the filters I've talked about in terms of size, in terms of jurisdiction, in terms of commodity. You might get down to 30, 35 potential dance partners, and you start engaging dialogue.
Okay.
It's about if we both have about the same PNAVs, you could argue that's not diluted. So it's not about one buying the other. I mean, there's obviously mechanics in the transaction, but it's about, hey, we're combining and they need to, and both share the same vision in terms of growth and what makes sense. My preference is highly, let's call it paper transactions, using each other's respective paper in a combination with maybe not even premiums or minor premiums. And it's not that I'm averse to using cash. That's certainly an element of it. But I've been in this industry long enough that to a certain point, you want to make sure your working capital is sufficient. Things will happen sometimes you don't see coming. You're public companies. You're as good as your last quarter. So you want to make sure you have cash to invest in the combined pro forma on the understanding there's a good return for that investor, development and infrastructure, and exploration especially. So to answer your second question, while that's going on, we're not stalling and waiting for that. We are continuing to, in fact, I've doubled the amount of exploration spend we spend in our company. We spend 10 to 15 million US a year. All numbers I talk are US dollars. In exploration, kind of, 30% Björkdal, 70% at Costerfield. That's double what we used to spend. So ramping that up on both near mine exploration and regional exploration within our tenement package to continue to replace reserves and potentially even grow them even further. But manage the expectation. The mine will never double in size.
Yeah.
But if they continue to generate that cash and we keep them going, that's a great story and is part of that return to the shareholders.
Yeah, I think, well, that's good. Doubling exploration, just because it's so hard to do growth. People use the word growth kind of casually, I feel, doing growth. And I feel that the exploration, or organic exploration, clearly is going to be the cheapest form of ounces that you'll find.
$15 an ounce at Björkdal and $40 an ounce at Costerfield. That, like I said, that's 1 to 2% of the spot price. So while it's never a guarantee, you don't hit it out of the park every time. I get that. You have to be very careful how you spend those dollars. Most of your exploration dollars go at the end of a drill bit. So you're not just drilling randomly. There's obviously a science behind that. But correct, that's the most efficient form of growth, even if there's some general constraints in that area.
Right. If I look at the team, your team, the efficiency and optimization is that's got to happen. It must be happening in the context of a market like we've seen, where a lot of things have gone wrong out there. We won't name names, but we've seen all sorts of big companies going through either kind of build phase and overrunning. We've seen them in production and issues happening. And I'm not going to point to people because, there's lots of reasons why that happens, and I don't want to attribute specific blame, but the point is it's not a good advertisement for the market as a whole. How do you look at your team in terms of ensuring your ability to not just consistently deliver the ounces and therefore the revenue, but ensure that nothing goes wrong?
Yeah, great question. I want to make it clear. There are always risks in this industry. But the first thing for me is, when I came here last year and joined the company, it's a great team. And they were, we never advertise internal budgets. We give external guidance. But, kind of 20, 25% on budget. We were never able to make that up. And so my first, clear discussion with my team is let's have a clear, transparent, not overinflated budget of what we think we're going to do. I'm looking at it for now in annual windows. But then if we say we're going to do that, let's commit to that. And if anything, I tend to be a little bit conservative because I'll give you a simple example, Matthew. If you have a 400 ton per day mill, let's say, if one day you get 300 tons through that mill, something happens. You're not putting 500 ton through it the following day, right? So with smaller operations, you can sometimes have those little tips. So you want to build in some flexibility. I have that. So that's the first thing, is to have a reasonable budget. Let's make sure we can execute on this. That's what we've been doing this year, executing. Do what you say you're going to do. Build in contingency. And then I'm a big believer on, maybe it's the engineering me and operating side, is focusing on what I call lead KPIs, key performance indicators. But not the lag stuff. That's great. That's the ounces and the cash. But what leads to that? Do you have the right number of working faces available? Do you have your development in advance? So to give those examples that which I probably know what you're referring to, speak to, separate from capital build, that's, just be clear what you need to do to deliver. Have a bit of contingency in there. There will be bumps. I get that. Understand what the KPIs are, and then execute on that and reward accordingly, right? So the team get that. I'm not one of these executives that come in and what's your plan, and I've seen it before. It's okay, jack that up by 20%. That's what we think. Turn that into a spreadsheet exercise. That's not how it works. And you demotivate your team. On the flip side, if it's their plan, and you make sure you push them. You don't have to say, I do what you got. But then they own that plan, and then they understand the importance of delivering, and you compensate accordingly. And then I think investors look for that part of it at least. Please do what you say you're going to do, but in some unforeseen event. Even then, it's our issue to deal with if we have that.
Right. Okay.
So does that answer your question?
Yeah, it does. Obviously saying it and doing it, showing it, two different things, right? But can we talk about the antimony? And again, initially just about your attitude to it in terms of it's hot at the moment, right? China said, right, we're going to change the market dynamics as they have wanted to do occasionally. There's no kind of reliance on it. There's no change of plan just because the last couple of months it's been popular.
No, look, if I had a special section in the mind that, hey, that's antimony, let's go grab it. It doesn't quite work like that. It comes along for the ride, and we generate concentrates at all our mines. We actually don't pour door it.
Yeah.
So our gold-antimony concentrate, it is a nice bonus. It certainly reevaluates some of our mining plans because it changes your cutoff grade you might use. And hey, we can actually mine lower grade here and make the same amount of money on it. Yeah. Based on the flexibility of your mine plan. So that, has gone from $10,000 an ounce up to $23,000, $24,000 an ounce. As I stated, there are many reasons for that, but China's reserves are depleting. They realize the importance of antimony. It's a strategic, critical mineral. It used to always be flame
retardant,
high-end stuff you do in planes, not in your house, but also, solid-state batteries. But it's got an increased use for taking air bubbles out of solar panels. And there's more and more of that happening in China. They have a big demand. I know there's the military element that's been around since World War I. Sadly, in today's world, that gets a fair bit more focus. You would have seen the U.S. Department of Defense, what they did at Perpetual and other ones. However, so that's driving the price, and I don't rely on that high price going forward. We don't bank on that. Is it nice that that's the case? Yes. We've seen some companies playing that up, which good for them. I chuckle a little bit because I think, well, you ever can get that mine permanent, but that's the exploration side of the game. I'm more into producing. We are the only permitted producer of antimony in all of Australia, let alone the state of Victoria that we operate in. So that's a great benefit.
Okay. So, and a conscious of time, you've got places to be, people to see. You got to talk to your current shareholders who are, I guess, liking the fact that this cash flow keeps coming. It gives you, you're not diluting them, giving you optionality in terms of this acquisitive growth strategy, and I guess also the organic component too. But they're going to want a sense of timing from you. You've been here, year and
16 months. Yeah.
16 months. Yeah. Now. You've digested it. You've got strategies. You've got plans. You've kind of got this culture. I like that bit, by the way. I like the culture that you've imbued in the company. Now they're going to start pushing and go, okay, you've done that bit. When do we start seeing the benefit of all of this?
Yeah. Well, I mean, I guess some of the benefits from April until yesterday, the price went from $1.50 to $3.18. So. Although I don't pat myself on the back too much because I know how the cycle can go. But there's the right, let's say, direction of the trend in the share price. But as far as the actual execution, separate from operational execution, I know our window, it's without panicking, doing the wrong thing. I would say within the next 6 to 12 months, you would certainly, be seeing some news for us, which is quite of interest at most. And again, I never believe in putting ourselves into a corner. We give ourselves options. And there's obviously a number of things I'm not going to or can't discuss specifically. But, I think there are other like parties that have the same concern and frustration. And how do we band together, for lack of a better word, to create more capacity and ultimately ounces, cash, margin, and return to shareholders.
Okay, so I'm loving the focus on margin, a rare topic when I speak to people on this push. But the reason I'm pushing you a little bit on this one is because of the antimony. You've seen the share price appreciation, which is fantastic, and that's a reaction to the vagaries of the market at this time. But your job is also to set expectations for people, because sometimes some companies suffer from retail getting ahead of itself. Luckily, you've got 75%, in good hands, but sometimes retail gets a little bit excited because expectations are very different from what you're signaling. But that's for you to manage. So what's the kind of final message in this conversation as to what the company profile is and what type of investor you should be to be in this project, yours?
Look, I would say we are a medium to lower risk because we have no encumbrances, no royalties, multi-asset, different jurisdictions, multi-commodity. We have no big growth capital apart from exploration, so we don't have a capital blowout risk. We are producing. We're generating cash. We're tier 1 jurisdiction. I'm not giving outrageous promises. If you look at our investor decks, there's probably, one page. Maybe I undersell a bit. One page of the 20 that's on antimony. I don't put 6 pages up there. So, I'm not in to try and pump that way. I believe things have to be sustainable. I've been in the business long enough. We have been probably accused of maybe being a bit conservative, but I'd rather ensure we deliver and say what we're going to do, execute on what we're going to do, but continue to grow. That is important for us, and ultimately in shareholder growth. That's really in the key metrics that go with that.
Okay, man. I enjoyed that conversation, and lovely to hear the story. Thank you.
Thank you, Matthew. Appreciate it.